Have you ever wondered how Warren Buffett, one of the wealthiest and most successful investors in the world, manages his money? Imagine having access to the best practices that Buffett himself uses to build and sustain his vast fortune. With a net worth in the billions, Buffett is renowned not only for his investment prowess, but also for his straightforward financial principles that anyone can apply to their lives. In this video, we'll unpack 10 genius things Warren Buffett says to do with your money. These tips come directly from Buffett's decades of experience in the market, and they're designed to guide you, whether you're just starting out or looking to refine your investment strategy. If you're ready to transform your financial future, don't forget to hit the like button, subscribe to our channel for more insightful content, and ring the bell to never miss out on expert advice that could make you the next big success story in investing. Let's get started and delve into the wisdom of Warren Buffett. Number 1. Start investing early. One of Warren Buffett's most emphasized principles is the importance of starting your investment journey early. Why? The secret lies in two powerful words: compound interest. Buffett often quotes Albert Einstein, who supposedly called compound interest the eighth wonder of the world. It's the process where the interest you earn on your savings or investments starts earning interest on itself, leading to exponentially growing returns over time. Let's break it down with a simple example. Suppose you invest $1,000 at an annual return rate of 10%. After the first year, you don't just have your initial $1,000. You have an additional $100 from interest, totaling $1,100. In the second year, you earn interest on $1,100, not just the original $1,000, giving you $1,210 by year's end, and so on. Starting early maximizes the time your money has to grow through this compounding effect, turning small initial investments into significant sums over the decades. This is why Buffett advocates for making investment a priority as soon as you start earning. Number 2. Invest in what you know. Warren Buffett strongly advocates for investing within your circle of competence, a straightforward but powerful concept. This means sticking to investments in industries or sectors you understand deeply, rather than venturing into unfamiliar territory. Buffett believes that when you invest in what you know, you're more likely to make informed decisions and identify potential risks and opportunities. For example, if you've worked in the technology sector, you might be better equipped to understand and predict trends in tech stocks, as opposed to pharmaceuticals or real estate. This familiarity can provide a significant advantage in assessing the value and potential of investments within that area. Buffett's approach discourages chasing hot tips or jumping into the latest trends without sufficient knowledge. Instead, he encourages investors to expand their circle of competence through continuous learning, but always emphasizes that the safest and most profitable place to invest is within the boundaries of what you truly understand. This method not only minimizes risks, but also boosts confidence in your investment choices. Number 3. Reinvest your profits. Warren Buffett's strategy of reinvesting profits is a cornerstone of his financial success. This approach involves taking the dividends and earnings you receive from investments and using them to purchase more shares or assets, rather than spending them. The benefit of this tactic is that it supercharges the compound interest effect, allowing your wealth to grow exponentially over time. For instance, if you own stock in a company that pays dividends, instead of taking those dividends as cash, you use them to buy more shares of the company. Over time, this increases the number of shares you own, which means you'll receive even larger dividend payments in future cycles, which can then be reinvested again. This cycle of reinvesting increases your investment base and potential returns without requiring additional out-of-pocket capital. Buffett himself has famously reinvested earnings from his investments, particularly through his company Berkshire Hathaway, to amass greater shares in select companies, significantly multiplying the original value of his investments. This disciplined reinvestment strategy is a key reason for the exponential growth of Buffett's portfolio over decades. Number 4. Avoid debt. Warren Buffett has always been wary of debt, viewing it as a significant barrier to financial growth. He often points out that high-interest debt, such as credit card debt, can quickly erode your financial resources as the interest expenses can outpace most investment gains. Essentially, while investments aim to increase your net worth, debt actively works against you, multiplying over time in the opposite direction of the benefits accrued from compound interest. Buffett's advice on managing debt is straightforward. Avoid borrowing money to fund lifestyle expenses or speculative investments. He suggests living within your means and using surplus funds to invest rather than to service debt. If you already have debt, prioritize paying off high-interest debts first, which often means tackling credit card balances and consumer loans before focusing on lower-interest obligations like mortgages or student loans. By maintaining a disciplined approach to debt, you can preserve more of your capital for investments, which can grow over time, following Buffett's principle of keeping your money working for you, not against you. Number 5. Build and maintain cash reserves. Warren Buffett emphasizes the importance of maintaining ample cash reserves, advocating for liquidity as a critical component of a sound financial strategy. This liquidity serves two main purposes. It provides a safety net during economic downturns, allowing you to cover unexpected expenses without having to liquidate investments at potentially low prices, and it enables you to seize investment opportunities when they arise, especially during market dips when assets can be purchased at a discount. Buffett advises that the size of your cash reserve should be sufficient to cover several months of living expenses, ensuring financial stability even during personal or broader economic crises. Additionally, he suggests keeping these reserves in highly liquid forms, such as savings accounts or money market funds, which allow quick access to funds without significant loss in value. Managing your cash reserves effectively means balancing between too much liquidity, which may result in missed investment gains, and too little, which increases financial risk. The key is to find a comfortable level that supports both security and opportunity. Number 6. Be fearful when others are greedy. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This maxim captures a fundamental principle of contrarian investing to resist the herd mentality that can lead to inflated asset prices and investment bubbles. When the market is overly optimistic and investors are aggressively buying, asset prices often rise beyond their intrinsic value, increasing the risk of price corrections or crashes. Historically, this pattern is evident in events like the dot-com bubble of the late 1990s and the housing market crash in 2008. During these periods, excessive optimism led many to invest heavily at high prices, only to suffer significant losses when the markets corrected themselves. Buffett's approach, by contrast, is to exercise caution during such times, recognizing that high demand can lead to overvaluation. By being fearful when others are excessively greedy, investors can protect themselves from potential downturns and financial losses, adhering to a more disciplined and rational investment strategy. Number 7. Be greedy when others are fearful. The flip side of Warren Buffett's advice to be fearful when others are greedy is to be greedy when others are fearful. This encourages investors to look for opportunities during market downturns when fear and pessimism can lead to undervalued asset prices. In these moments, while most are selling off assets in a panic, shrewd investors can find high-quality stocks at discounted prices. For instance, during the financial crisis of 2008, many stocks plummeted to prices well below their intrinsic values due to widespread fear. Buffett, seeing the long-term potential of certain companies, chose this time to invest heavily, acquiring significant stakes in companies like Goldman Sachs and General Electric at bargain prices. These investments paid off handsomely as the market eventually recovered. The key to applying this strategy is thorough research and a solid understanding of a company's fundamental value. By maintaining a calm demeanor and a discerning eye during market turbulence, investors can capitalize on the fear-driven mispricing of assets, setting the stage for substantial gains when market sentiment turns positive. Number 8. Focus on long-term growth. Warren Buffett is a staunch advocate for focusing on long-term investment strategies, a principle that underpins his financial success. By concentrating on the long-term growth potential of investments rather than short-term fluctuations, investors can benefit from the stabilization of returns over extended periods and the significant impact of compound interest. Buffett's investment in Coca-Cola exemplifies this approach. He began investing in Coca-Cola in 1988, recognizing its enduring brand value and global market presence. Decades later, this investment remains a cornerstone of Berkshire Hathaway's portfolio, having appreciated substantially over time and provided consistent dividend income. This long-term perspective allows investors to ride out the volatility of markets, reducing the risk of making poor decisions based on short-term market movements. Buffett often emphasizes that our favorite holding period is forever, suggesting that the best returns come from investments that are held indefinitely, allowing their intrinsic value and earnings potential to fully manifest. Number 9. Keep learning. Warren Buffett's success is not just a product of his investment choices, but also his unwavering commitment to continuous learning. He famously reads extensively, about 500 pages a day, and believes that constant education is crucial in the rapidly changing world of finance and investing. This habit keeps him informed about market trends, economic conditions, and corporate governance, enabling more informed investment decisions. Buffett encourages investors to adopt a similar approach to learning, suggesting that the more you learn, the more you earn. This doesn't necessarily mean formal education, but includes reading financial news, books, annual reports, and engaging with other knowledgeable investors. Staying updated and understanding diverse economic and financial contexts can help investors spot emerging trends and avoid outdated strategies. By prioritizing education, you can enhance your financial literacy, leading to better investment choices and strategies that adapt to both current conditions and future possibilities. Number 10. Give generously. Warren Buffett is not only one of the world's most successful investors, but also one of the most prolific philanthropists. His commitment to giving generously is integral to his financial strategy. Buffett pledged to give away over 99% of his fortune to philanthropic causes, primarily through the Gates Foundation. He believes that wealth has a social responsibility and that sharing it can create significant positive impact. The benefits of philanthropy extend beyond social good. It can also lead to personal fulfillment and happiness, enhancing one's legacy. Additionally, charitable donations can offer tax benefits, which can improve an individual's financial situation, allowing for further growth and the ability to contribute even more significantly over time. Remember, the path to financial wisdom involves continuous learning and disciplined investment based on sound principles. If you found these insights helpful, don't forget to like, subscribe, and click the bell icon so you won't miss any of our upcoming videos. Share this video with friends who might benefit from these timeless financial strategies.